Good morning and welcome to this month's webinar here at the New Hampshire Insurance Department, where we will be discussing various life insurance products. I'm joined by a couple of my colleagues, Victoria Fowler, who's the Administrator of Life and Health Compliance, and Gregory Arce, our Examiner in Charge at the Market Regulation Unit. As always, we've got Commissioner Betancourt. Before I turn it over to him for opening remarks, just a couple of housekeeping notes. This and all of our other webinars can be found on our YouTube page, and I've posted that link in the chat. And if you have any questions, we encourage you to ask them at any time during the presentation. We will have the chat box open, and at the end, we'll have time to address the questions. If you have any questions at all in general, I've put our consumer services email and telephone number there for you, so make note of that. Without further ado, I'll turn it over to Commissioner Betancourt.
Well, thanks so much, Andrew. As Andrew mentioned, my name is DJ Betancourt, and I have the pleasure of serving as the Commissioner of the New Hampshire Insurance Department, taking this webinar from the road as I'm off to an event for the department, but still great to be with you all. So look, in full candor, the topic today is incredibly important, but I'll admit it's not the cheeriest topic in the world, but it is so important. Scientifically speaking, we know that humans have a sophisticated level of self-awareness and the cognitive ability to contemplate the future, which is different and unique from all of the other creatures that we have here on Earth. And unfortunately, or fortunately, that also includes our awareness of the inevitability of death. And so we're talking about life insurance today. And for me, and for those of us with families, we know that the biggest predominant benefit, although there are many that we will talk about this morning, we know that the benefit of having life insurance is the financial security for our dependents, for our loved ones. The primary purpose of life insurance is to provide financial protection to those in our lives who we love and who depend on us in the event of our death. And this can be crucial for families who rely on us or whoever the policyholder is, their income for their everyday living expenses, their mortgage payments, the education costs, and other necessities of life. And with that security comes the peace of mind for us, for the policyholder, knowing that having life insurance is going to provide for our loved ones, knowing that they will have this financial support. God forbid something should happen to us unexpectedly. And hopefully that will alleviate stress and provide some comfort about the future. Human nature will never change. We're not going to want to think about something bad happening to us or our death. But understanding the importance of having the protections in place for our family is so important. And so while life insurance can be an integral part of a financial plan, the need for it and the type of policy that might be best for you and your family is going to vary based on the individual circumstances of your life, such as your age, your financial situation, family structure, and long-term goals. And so it's important to assess your specific needs and think about it very carefully to determine the most appropriate coverage for you. And to help you think through some of those things, we've got two phenomenal subject matter experts here at the department, Tori Fowler and Gregory Arce, who are again going to give you some information about the things you're going to want to think about, the differences of one type of coverage over the other, and hopefully it will help you begin to think about what might work best for you and your family. So with that said, I'm going to turn it over to them, but I'm going to look to all of my staff to make sure they don't let me forget at the end of this webinar to talk a little bit about the Lost Policy Locator, which has been a huge difference in the lives of a lot of people. But we'll get to that later. I'll turn it over to Tori and Greg.
Good morning, everybody. Hope you're having a happy Thursday. We're excited today to share our life insurance presentation with you, and we hope that you're able to gain some newfound knowledge regarding this complex topic. First, we're going to dive into why do we need life insurance? Life insurance prepares us for instances of premature death. A premature death is the death of a family head with outstanding, unfulfilled financial obligations. Life insurance can help protect people from the cost of a premature death. When a family head dies, typically the income associated with that family head disappears, and families need to find ways to compensate for that financial deficit. Historically, premature death was more common than it is today because of an increase in life expectancy. There is a declining problem of premature death. This means that people may not be realizing the economic justification for life insurance. If the insured has earned income and others are dependent on those earnings for part or all of their financial support, there likely is a need for life insurance. Different types of family units may need different amounts or types of life insurance. For example, unfortunately, single-parent families generally need the most life insurance, but typically are the least likely to obtain life insurance. Other types of family units include 2 income earners with children. This is a situation where both income earners need substantial amounts of life insurance. Traditional families is a situation where the working parent in the labor force needs a substantial amount of life insurance. Blended families, where the need for life insurance on both family heads is great. And sandwiched families. Sometimes a working spouse is in a sandwiched family situation and may need a substantial amount of life insurance. While I'm not going to go into these calculators, I just wanted to let the audience know that there are a lot of tools available online to help somebody get an idea as to how much life insurance they may need based on their income and their expenses and their obligations. So I would encourage people to take as a first step, to explore some of these calculators and see, just get an idea of how much insurance you may need. I did want to mention that speaking with a professional is always recommended. In addition, I've posted an article here, and the article explains common misconceptions that prevent Americans from getting life insurance they know they need. And in this article, common misconceptions include the over-reliance on employer-sponsored life insurance and also being intimidated by an invasive underwriting process. We'll get into that a little bit more later. In addition, people feel that life insurance can be too expensive. They may not understand a complex policy, or they may just want to avoid and procrastinate, waiting for a better time to deal with it. The opportunity cost of life insurance is what the insured policyholder gives up when life insurance is purchased. For example, if you need to spend $50 a month on term life insurance, that is $600 a year that you're not spending on something else. We just wanted to remind the audience that on average, a 20-year term, 40-year-old non-smoker individual, in order to get a $500,000 term benefit, would only cost about $50 a month. So that's about an average cost of term life insurance, which can really boil down to as little as a cup of coffee a day. Today we're going to review some different types of life insurance. As I mentioned previously, there's term insurance, and there's also what's called permanent or whole life insurance. And under that umbrella, we have whole life, variable life, and universal life. To start with term insurance is the basic vanilla ice cream type of life insurance. It's easy to understand typically. The period of protection is temporary, so you arrange for a term, whether that's 1 year, 5 years, 10 years, 20 years, you're only covered for that specific term. Term insurance is also generally renewable. What this means is you can oftentimes renew your term insurance without submitting a new evidence of insurability, which is the medical underwriting that I alluded to earlier. Term insurance can be convertible. Some people choose to convert their term policy into a cash value policy without evidence of insurance. However, with the term type of product, there is no cash value or savings element. There are different types of term insurance. A yearly renewable term is issued for 1 year, and the policyholder can renew for successive 1-year periods until a stated age without having to demonstrate evidence of insurability. In addition, there's a fixed duration term where the premiums paid are level and will increase after the term is completed and the policy is renewed. And finally, there's a term to age 65 product, which provides protection until age 65, then it expires. So it's important for people to analyze, how long of a period are they going to require this type of insurance for? And oftentimes that's based on family needs. A classic example is, having children and the children grow up. So you may need the insurance while they're minors, and then once they graduate to adulthood, that need for the insurance may lessen or even go away completely. Some other types of term insurance include decreasing term insurance, where the face amount, which is the benefit, gradually declines each year, yet the premium stays level throughout the term. This is a great structure for a person whose financial obligations decrease as they age. Again, similar to where children are growing up and transitioning to being able to support themselves. There's re-entry term, which allows the policyholder to reapply for coverage at a lower premium if the insured can periodically demonstrate an acceptable evidence of insurability. So in this case, the insured is being rewarded with an acceptable evidence of insurability, which means if they're in good health and taking good care of themselves, they may be able to renew their insurance at a lower premium than their peers. And finally, there's the return of premium, which is a situation where the term insurance refunds premiums if the policyholder survives the policy term. When is term insurance appropriate? Because term life insurance is usually less expensive than permanent life insurance, it can be appropriate for someone who has limited funds to pay for life insurance. Term insurance is temporary insurance, like we discussed previously. So if the need for protection is temporary, term is most likely the appropriate product. Finally, many term policies offer the ability for the policyholder to convert term coverage into permanent insurance without submitting that medical underwriting evidence of insurability. This option can guarantee insurability even if the policyholder becomes uninsurable. Some of the limitations of term insurance are that the premiums increase with age at an increasing rate and eventually reach prohibitive levels. Also, term insurance is inappropriate if you wish to save money for a specific need. There is no accumulated cash value component associated with a term product. It is merely a protection measure and not a savings component, no savings component. Now we're going to pivot to a completely different type of product. Gregory will present the types of permanent life insurance.
Thank you, Tori. And if term life is the vanilla ice cream, now we'll be looking at the chocolate, the strawberry, and maybe the mint chocolate chip. But permanent life insurance is insurance that will build a cash value as you make your premium payments. It gives you a savings component to your life insurance policy. As you make your payments, a portion of that goes into an investment or a kind of like a savings account that earns interest or investment gains, and so that grows over the life of your policy. This type provides lifetime protection, so it's not just a term or a stated number of years. You typically will have a permanent policy for the duration of your life. So whole life, sometimes known as ordinary life, is a policy that remains in effect for a lifetime. We have mortality tables that now say 121, and that's what they base the premiums on. And so you can hold this for the duration of your life. With the whole life policies, the premiums will stay level. They won't increase. So as you buy your whole life or permanent policy at a younger age, you're in better health, your premium payment will be lower, and so that payment will stay the same throughout the life of the policy. With these permanent policies, they do have they will have surrender values that will accumulate over the time of the policy. So as your policy grows, if you decide to cash out that policy, you can take the cash value less expenses or any outstanding loans and have that amount paid out to you. So that's one of the benefits of a permanent policy. So when would somebody use whole life or ordinary life insurance? When would you do that over term? And so the answer's in the name. If you want it for your whole life, you would do a permanent policy. Because it's not going to run out of insurance in 10, 20, or 30 years. The other reason that individuals can purchase whole life, ordinary life, is because it has a savings component to it. I call that a forced savings. A lot of individuals won't be disciplined enough to set aside money each month in a savings account or an investment account. However, they are likely to pay a bill when it comes due. And so they see the invoice or the reminder to pay their life insurance on a monthly basis, and they will pay that where they might not set aside, $75, $120 for an investment. They are more likely to pay a bill, or what they see as a bill, and pay their life insurance. And so it kind of forces individuals to save money. So what are some of the limitations of these permanent policies, whole life in particular? One which we've mentioned is it is more expensive than term policy, and so sometimes people will not buy as much insurance as they need because the cost is greater. So they tend to be underinsured. With being underinsured, there are a couple of things you could do. Sometimes it does make sense to buy term insurance. If you can't afford the whole life policy, it might be a better option to buy term insurance for a specified number of years. Another thing you can do is do a hybrid, and so you'll purchase your whole life policy, and for the number of years that your kids are at home or going through college, or you have a mortgage, you might buy a 20 or 30-year term to go along with your whole life policy, and that way when the term policy expires, you're still covered by that whole life policy that you purchased when you were younger at a lower premium. Limited payment life insurance is a type of life insurance, a type of whole life that you have a set period of payments and lifetime coverage. And so it's kind of has some term structure to it in that you pay your premiums for a number of years, but you have the whole life coverage. And the way the insurance companies do that is your premium payments are going to be higher than with a term policy because they are looking at covering you for your whole life. And so they're looking at those mortality tables and calculating how much premium you would need to pay over the next 20 or 30 years in order to cover you for a lifetime. So the rates are going to be higher, but then you don't pay those premiums indefinitely. You know, you might pay them throughout your working years and then be able to stop your payments. At that point, your policy is considered paid up, and all that means is the insurance company said you've paid enough premium to cover the death benefit that we've set apart. Finally, there's a single premium payment, which is similar to what I just mentioned, but instead of making it for a set period of time, you only make the one payment. Usually that is set aside with somebody who gets a large amount of money, maybe an inheritance, something like that. They take that money and they roll it into a life insurance product, and that will be a single premium life insurance product. That will give them lifetime protection. So some of the other types of permanent insurance are variable life insurance and universal life. And so first we will look at variable life insurance. Variable life is a fixed premium policy, and with this policy the death benefit and the cash values will fluctuate based on the underlying investments in the separate account which is maintained by the insurer. Separate account is similar to a mutual fund in that it is a bucket of stocks or investments that is the money goes into, and these investments are purchased, and so the values will go up and down. And so with that increase and decrease, your death benefit and cash value can fluctuate. The only non-variable in variable life is the premium. You do need to make the premium payments each month or quarterly, however you have it set up. But that remains the same, but the underlying investments will go up, so your benefits can fluctuate. Cash surrender values with these policies are not guaranteed, and there's no minimum guarantee of cash value like you would see in whole life policy. And that's because it's not a simple bank account or treasury notes that it goes into. It's going into actual investments that fluctuate. With this type of policy, the insurer, so the insurance company, bears the risk of excessive mortality, so living longer and greater expenses, but the policy holder, the owner of the policy, is the one who bears the risk of poor investments. So they're the ones that will suffer if the investments do not perform well. Next, we'll look at universal life. And so this is another twist, another flavor on the insurance products. And with universal life, it offers a lot of flexibility with the premium. With the premium for these, the individual is able to determine the amount and the frequency that they want to pay. So they can pay more some months, they can skip a month if finances are tight. But the only caution for that is the cost of the insurance and mortality needs to be covered. So if you skip too many months, you're not covering the charges, your benefit is going to go down because you're not covering it. And then at a later date, you may have to invest or pay in a lot more premium to get that coverage back. So with keeping with universal life, moving on, there's they unbundle some of the different parts. So you have the coverage for your life insurance, but also there's that savings component that is separated out. With these types of insurance companies or insurance products, as with most of the insurance products, you will get a statement. The owner will get a statement each year, and what this statement will detail and will actually show the math behind it and how things are calculated, but it will show the amount of premiums that are paid into it, the death benefit amount, which remember can fluctuate, so it's a good thing to pay attention to these statements, as well as the cash value that's going to be going up and down with the underlying investments, as well as the mortality charges and the interest that has been credited to the cash value account each year. With universal life, there is also flexibility, similar to the variable products. With these policies, the universal life, the policy holder determines how much, like I mentioned, and when they pay it. But again, there's a caution with that because the benefits will go up and down. And you can get into the trap of taking a break from paying your premium, and then next thing you know, you're in trouble because your policy is about to lapse, and so you have to put in more money. So that's the only caution I would give, or I should say one of the cautions I would give with a universal life policy. One of the benefits is you can overfund a universal life policy, and that means you can put in additional cash for it, and then you're actually beefing up your savings with that. It is subject to IRS regulations. If you put in too much money, it turns into what we call a MEC, or a modified endowment contract. And when that happens, the IRS says this is no longer an insurance product, this is strictly an investment, and you lose the tax benefits of the life insurance product. So if you have one of these and you're looking to overfund it, just be cautious that you can overfund it. So talk to a financial advisor, a tax accountant, somebody that can help you figure out how much you can overfund these accounts. Another benefit of permanent insurance is you're able to take loans against your policies. But again, there's a caution with that, because as you take the money out, you can be reducing your death benefit and the cash value. But one of the benefits is you pay a lower interest rate, and when you pay back that interest rate, you're paying it back to yourself. So you pay that money back in, and if you don't pay it back, what that does is it reduces the death benefit. So if your needs change and you have a need for a lower death benefit, it might make sense to take loans out against it and reduce the benefit. Some of these policies also allow you to add other insureds. So you can add additional people to your policy. Next, we're going to look at just a couple of other types of life insurance. There's a modified life insurance, which is a policy where your premiums start low. So they'll be low for the first 3 to 5 years, and then they can increase. Often those increase in steps or intervals. So, year 5 it might increase, year 10 it might increase. And those increases are going to go along with the increase in mortality, how much it costs to insure somebody of your age. Similar to what we mentioned with the universal life is the adding additional insureds, is there is a second to die life insurance policy. Sometimes this is called joint life or survivorship life. And this is a policy that will insure multiple people, and it will pay out the death benefit upon the second to die, so the last individual to die. And this might be for a husband and wife. They might have a joint policy like this, and when the first passes away, it doesn't pay out, but then when the second passes away, then it would go to the beneficiaries or to their children or a charity, whoever they have designated. And then the last type of insurance is group life. Most people will be familiar with this as employer-sponsored life insurance. Many will have it through their employers, where they can have life insurance. Often it's a factor of their salary, or they can buy up to additional 50,000, 100,000 increments. But that is group life. That's usually handled through an employer. And that has all of the insureds in one big pool, and so the cost of that insurance is lower for each individual. And so those are the types of insurance that we're talking about today.
Tori and Greg, thank you so much. A lot of really useful information there. You know, it's interesting. The concept of life insurance dates back to, believe it or not, ancient Rome, where burial clubs would collect funds to cover funeral expenses of deceased members. You know, these early arrangements laid the groundwork for the more formalized insurance systems and products that you heard described here today. The oldest active life insurance policy was issued in the United Kingdom in 1765. So, for those of you who are trivia buffs, now you've got a little extra knowledge in your back pocket. But I think it demonstrates the long-standing nature of life insurance as a financial tool. But we know at the department that despite the long history of this product, there's still a lot of public awareness that needs to take place. And it advances what I've called, and it's one of my big goals as commissioner, is to increase insurance literacy in New Hampshire. And obviously, we hope that today's webinar is helpful in helping folks to understand a little bit more about the wide array of options that they have around life insurance and start to think about what works best for them. Tori raised a really important point, and we always advise consumers of this, that one of the best ways to get more information or to ensure that you are getting the best policy for you and your family is to work with an independent agent. They're going to sit down with you. They're going to go through all of the wide array of factors that you're going to want to consider as you choose the best product. So as mentioned, I did want to talk about the Lost Policy Locator. So the Lost Policy Locator is a service designed by the National Association of Insurance Commissioners, and it is designed to help individuals find life insurance policies or annuities contracts that they believe exist, but for which they don't have the pertinent details or documentation for. And so if a loved one has passed away and you think that they had a life insurance policy, or even if you don't know and you just want to check to see if they had a policy, but you can't find any of the documents, this Lost Policy Locator service can really be invaluable. You can access that tool right on the department's website, which is insurance.nh.gov. It's right there on the front homepage. And again, it's a useful service to ensure that beneficiaries can access any benefits that they're entitled to, which obviously helps to avoid potential financial loss associated with an unclaimed policy. One last item to share. Last year, we became aware from a number of consumers and insurance carriers that they were having a difficult time processing life insurance policies and paying out on those policies because the death certificates that individuals were receiving from their municipality, the place that they live, did not include a critical detail, which was the cause of death. And so last year, the department worked with municipal clerks across the state to emphasize the necessity of including the cause of death on that death certificate so that we can avoid insurance companies experiencing difficulties in processing claims promptly, and to make sure that consumers are getting the benefit of that policy as quickly as possible. But if there are consumers that are continuing to encounter that challenge, please do let us know. We can help you work through that, and we can ensure that you are getting access to the benefits that you are entitled to. So again, really appreciate today's discussion. I'm confident that this has been helpful. As always, we make these webinars available on our YouTube page so that consumers can come back and watch them at any time. They can rewind or fast forward depending on what particular topic they're looking for additional information on. And so hopefully this will again be a long-term source of information that consumers can use to learn more about life insurance and ultimately be able to get the best coverage for them. So with that all said, I'll turn it back to Andrew to see if we had any questions come in.
I don't see any questions in the chat. I've just put the communications email address there, so feel free to communicate your questions to us. We'll get them to the subject matter experts and try to get you an answer in a timely manner. Like we mentioned before, this and all of our other webinars are on our YouTube page, so we invite you to check those out. And next month, Commissioner, we'll be discussing...
Has yet to be determined. We're keeping our options open. We want to make sure that we're addressing an issue that is front of mind for consumers. And so we'll make a decision on that very, very soon, and we'll get the word out. We look forward to seeing all of you on our next webinar next month.
Sign up for our email list on our website, and you'll be able to get more information about upcoming webinars next month and into the future. We appreciate you and look forward to seeing you on another webinar. Thanks very much.